Welcome to IFX. Let's talk about the benefits of trading divergence. Let's use the RSI divergence. The RSI is a popular technical indicator that measures the strength of a price trend. It oscillates between 0 and 100, with values above 70 indicating overbought conditions and values below 30 indicating oversold conditions. Now, what is divergence? Divergence occurs when the direction of the RSI and the direction of the price trend are not in sync. Trading divergence can be an effective scalping strategy because it allows you to take advantage of small price movements in the market. When you identify divergence, you can enter a trade in the direction of the divergence, expecting the price to eventually move in the direction indicated by the RSI. First, make sure to add the RSI indicator to your chart and set the period to 14 or 21, which are the most popular. I usually use period 14 at close. How do you find bullish divergence? If the price is making lower lows but the RSI is making higher lows, this could be a bullish divergence. In this case, you could enter a long trade when the RSI crosses above its previous low, expecting the price to eventually follow and move higher. Let's take a look at some bullish divergence entries using the M15 reversal blocks. I usually prefer to wait until the price has hit yesterday's high or low before looking for an entry, but there are always exceptions to this rule where you can still get a divergence even though the price hasn't hit those markers. Take a look at this beautiful bullish entry. What do you notice there? Everything was met. There was a bullish divergence, price hit yesterday's low, the reversal block was formed, and at the time of the entry the RSI was at 40 or above. Where is the best take profit? You may ask. Here are a couple of options. Option 1, wait until the RSI reaches to the 70 level to take profit. Option 2, wait until price reaches yesterday's high to take profit. Option 3, wait until you get 20 to 40 pips to take profit. What about a stop loss? Option 1, place a stop loss order below the reversal block about 10 to 15 pips. Option 2, wait until a candle closes below the reversal block. Option 3, no stop loss placement. Do position trading and re-enter at a lower price. Keep in mind to keep 40 to 50 pips distance between trades. Here is an example where price did not hit yesterday's low. The bullish block was formed and it gave out a few pips. Notice the divergence there? How do you find a bearish divergence? If the price is making higher highs but the RSI is making lower highs, this could be a bearish divergence. In this case, you could enter a short trade when the RSI crosses below its previous high, expecting the price to eventually move lower. Let's take a look at some bearish divergence entries using the M15 reversal blocks. This is a great example of a bearish divergence. You can see that price hit yesterday's high, and at the time of entry the RSI was at 60 or below. This is a strong signal that the market is ready to move lower. The trade went on to the next day for a nice move. Here's an example of a bearish price divergence. Yesterday's high was not hit, but you can see that the price is still going down. What about take profit and stop loss? Follow the options given on previous example but do the opposite when selling. The more you practice spotting patterns, the better you'll get at it. The key is to spend as much time as possible observing the markets and seeing how the patterns develop. After a while, you'll start to see them more clearly and be able to take advantage of them more quickly. Do you feel more confident about your ability to spot an RSI divergence and enter the market using reversal blocks? Okay, now go take some entries following these simple rules. If you're enjoying this video so far, show your support by liking and subscribing to the channel. And be sure to share it with your friends. Arya, can you tell me a funny joke?
Why was the computer cold? It left its windows open.